Hello and welcome to another TLC Tutoring Company accounting lesson. In this video, we are going to be going over journalizing bond investments. So in this case for A, we have Diamond Inc. purchasing $150,000 of Jane Company 11% bonds at 100. So we're purchasing them at face value, plus accrued interest of $2,000. And they're also giving us a note that this bond pays interest semi-annually. We'll use that part later. But for now, let's go ahead and record that in A. We are purchasing some bonds. So we are going to have investments dash Jane Company bonds. And we are getting $150,000 worth of bonds. Now included in there, we are also going to have to pay an additional $2,000. Now this $2,000 is for interest, and since we did not own the bonds while this $2,000 in interest accrued, it's not our interest to have. So what we're doing now is we're prepaying that $2,000 initially, and we will be receiving that money later in the future once we receive that semi-annual interest payment. So once we get to that semi-annual interest payment, I'll go back and I'll reiterate this point. So in total, we are paying cash of $150,000 plus $2,000. So we're paying a total of $152,000 cash. Now, again, remember, keep in mind that $2,000 for interest receivable. It'll go ahead and come into play here once we get to B. Now in B, it says that we're receiving the first semi-annual interest payment. So let's go ahead and record that we're receiving that interest via cash, of course. Now, remember our formula for interest is PRT, principal times rate times time. In this case, our principal is $150,000, our rate is 11%, and it's semi-annual. So we are going to get the interest for just the 6 out of 12 months. Now keep in mind for this formula, you could have also, instead of multiplying it by 6 divided by 12, you could have also just divided your result for 150,000 times 0.1. You could just go ahead and divide that by 2. Either way, you end up getting this $8,250. So again, if I wanted to just go ahead and divide that result by 2, it still gives us the same thing. So we're still talking about half of a year, 6 months. All right, so now that we know that we're getting $8,250 in cash, let's deal with our credits. We know that we did not own this bond for the full 6 months because when we originally purchased it, it said that a portion of that interest had already accrued. So someone else owned that bond for that additional $2,000 amount. So for that $2,000, we are going to have to credit our interest receivable account, that amount that we originally put into interest receivable before when we initially purchased the bond. And any excess will go into our interest revenue account. So take another look at this. Essentially what this is saying is that we are receiving $8,250 in cash. We only owned the bond for a portion of that 6 months, which is why we only get to record revenue of $6,250. That additional $2,000 amount, we didn't earn it because we didn't own that bond during that period. The prior owners owned the bond during that period. So when we have that $2,000, we're not going to be able to record that as revenue. We prepaid that $2,000 so that they got the revenue that they were entitled to, and we got to record it as interest revenue and take it off the books once we received the full interest payment. Now you might ask yourself, why don't they just go ahead and only pay us the $6,250? And the simple answer is bonds just don't work like that. We have to make sure that the semi-annual interest payment is for the full 6 months. We can't just take $2,000 off because we didn't own it for that other part. We're going to receive a full $8,250 now. We prepaid that $2,000 that we didn't earn in the past. So go ahead and think about that. You might need to record the video and listen to that one more time. It's a little bit of a more advanced topic, but eventually if you start to put it into your own words and you can explain it to another person, you've likely mastered that concept. All right, let's take a look at C now. Now in C, it's saying that Diamond Inc. is selling 50,000 of the bonds at 99. So we have a little bit of a rate here, plus accrued interest of 1,000. So let's start by figuring out how much cash they're receiving. So they're selling 50,000 of the bonds at 99, plus they are getting 1,000 in interest. Now, what does that 1,000 in accrued interest mean for us now that we are the sellers? Since we're the sellers, this means that 1,000, we earned that $1,000. We are on the opposite side of the transaction from where we were in A. In A, we had to prepay that $2,000 because the original sellers had earned it. Now, we are the sellers. We earned that $1,000, so they're going to give us that extra $1,000 when they buy that bond from us. So that means that $1,000 for us, let me go ahead and put it down here, is going to be a credit to interest revenue because we owned the bond during that period where that $1,000 accrued. That is our interest. All right, now let's take a look at that next piece. We are selling our bond, so we're going to have to decrease our investments dash Jane Company bonds. And in our case, that 50,000 in bonds, it was issued at 100. It was issued at face value, so we can simply write off that 50,000 in bonds. Very easy. We sold 50,000, credit the investments account for 50,000. Now you might notice now that our debits do not equal our credits. We have debits of 50,500 and credits of 51,000. So in order to make those two balance, we're going to have to take that 50,000 plus the 1,000 and then minus out what's on this debit side. And you'll see it's that $500 that was missing. Now our debit side equals 51,000, our credit side equals 51,000. Now for this plug account, like other investment transactions, when we finally decide to sell the investment, this is going to be to a gain or a loss. If it's a debit plug, it's a loss. If it's a credit plug, it's a gain. In this case, since we have a debit plug, it will be a loss. So loss on sale of bond, debit for 500. And our journal entry is now complete. We are done. So I hope you enjoyed this video of a very basic example of journalizing those bond investments. Go ahead and take a look at your textbooks to see if you see any other kind of interesting scenarios that we might run into. If you remember those basic rules for bonds, you still should be able to get through them and journalize them. All right, thank you so much for watching, and until next time, happy studying.